Welcome back to Far From Wall Street. I hope everyone enjoyed their 4th of July holiday. This is Michael McCall for Wednesday, July 5th. Well, here it is. The S&P 500, a key to growth of capital in broadly diversified portfolios for the long run, posted a 2.9% gain in the second quarter of 2017, following a 6.1% gain in the first quarter. Now, the total return on the S&P 500 since 1926 has averaged about 10%, making the 9.2% return in the first half of 2017 an exceptionally strong start to the year. As 2017 started, the rally was driven initially by the promise of a major tax reform and slashing of regulations governing business. But by the end of the first quarter, a congressional stalemate over health care reform, which would finance the tax cuts, dashed hopes for tax reform. Despite this, a stream of strong economic reports repeatedly propelled stocks to new highs in the second quarter. So what exactly happened? Remember the term FANG stocks? You know, Facebook, Amazon, Netflix, and Google? Well, they staged a comeback and gained more than 17% in the first half of the year. Healthcare stocks, which account for a sixth of gross domestic product, also rebounded sharply and gained 6.2%. Energy stocks were the big losers among industry sectors. Domestic oil production has become more efficient and more U.S. rigs are in operation, yet the average price of a barrel of oil has stayed below $50 per barrel. While that's not good for oil stocks, it is a very positive development for the U.S. economy in the long run. Now look at this. In a turnabout from the fourth quarter of 2016, China, Europe, emerging markets, and Asia Pacific all outperformed U.S. stock indexes in the first half of the year. Also staging a turnabout, large company shares in the S&P 500 outperformed medium and small company shares in the same period. For the first half of 2017, stocks were the best performing of this diverse group of 13 asset classes, and non-U.S. markets beat U.S. stocks, with the S&P Global Index, excluding U.S. stocks, gaining 15.3%. Foreign economies posted improving economic data, and their stock markets caught up with the fourth quarter Trump rally in U.S. stocks. Gold rallied, reversing its fourth quarter slump on U.S. dollar strength. Oil, master limited partnerships, and commodities all posted losses. So, the Standard & Poor's 500 index closed the second quarter about 1% off its all-time high, hit just 10 days earlier. A correction of 10 or 15% could come at any time because of unexpected bad news. However, the outlook for the fundamentals that drive stock prices, corporate earnings, consumer spending, and inflation, remains bright for the rest of 2017 and 18, and stocks could continue to rise if things go as expected. Because no one can predict the future, a discipline built around broad diversification is best for managing your wealth over the long run. But keep in mind that being diversified means your portfolio will never perform as well as the leading asset class. By definition, diversified portfolios can't keep up with the returns of the S&P 500 in a bull market, but that also means you never will perform as poorly as the worst asset class. Here's what I mean. Diversifying is a systematic way of trying to moderate the ups and downs of investing for the long run. If you're on a path with steep ups and downs, you're less likely to get where you're trying to go. A frightful descent is more likely to make you abandon course. We all know this. If you own a concentrated, non-diversified portfolio, you know, the hot stocks with great stories that your friends love to brag about, it's great bravado, but you'll bail out when things get scary. The moderate path is not as exciting, but is easier to complete. This is not a sprint, it's a marathon. Well, that's the update for the week. Please contact my office with any questions or to set up a meeting, and don't hesitate to share this video with friends who might benefit from my work. Remember, it's great to be far from Wall Street.